No, I'm good. I just didn't know which order and
We'll go.
two
We'll
subjects
go in.
to talk
We'll
about
go
is
in hair order. You'll go first, then Bob.
okay. And the two things I could talk about obviously are the Fed, Trump announcement, and then credit card caps. Those are the two things I was planning on. And there are lots of different levels on which you can think about this. I mean, one of the things I was going to end with to lead into Bob is, picking winners and losers is what the Trump administration is all about. And do we really want that? I don't, Bob, did you see his comments about Exxon and Venezuela?
I don't know what specifically ones you're talking about. I know Exxon said Venezuela's uninvestable right now, but I don't know what it.
Trump said he was not going to, Exxon would not be part of their Venezuela plan.
Yeah.
So, if
You
you're
come
not
out
on
and say
board,
you come out and say it's uninvestable. It's like saying we're not changing interest rates. All right, you're out.
yeah, exactly. And I don't think we want that in a market, but that's what we got. Yeah. I've been writing a lot about this pay-to-play administration and the pitfalls associated with that.
Yeah, I mean, Trump's pretty black and white. Either you're with him or you're against him. Period.
Yeah.
Done.
So anyway, we can talk at the micro level, the macro level, the political level, whatever you want, David, is what I'm getting at.
Oh, let's post. All right. So, how was everyone's weekend?
Good. I don't look like a priest here this morning, do I? With my little collar.
No, no one would mistake you for a priest, Rob.
Come on, David.
You can confess what you think about the market.
No, it is cold enough for turtlenecks. That is true. In the Northeast, where are you, Charlie? Are you still in Colorado?
No, I'm in Connecticut now, so
okay.
It's really warm here today. Beautiful sun.
Really? It's cold here. It was 32 degrees this morning in New Jersey.
I think Charlie's just making it so it's warm in his house. He's yet to leave this weekend. He's like, it's warm here. I don't know. It's 72.
Warm and sunny.
Well, did you guys do anything fun over the weekend? Anything crazy fun? Watch any football?
I watched the Patriots. I'm a Boston sports fan, so I was rooting for that.
There you go. You had to be happy.
I was actually very impressed with the defense. They've been on.
Yeah, next weekend we take my daughter back up to college, so it's her last free weekend before the spring semester starts.
Is she excited to go back? Enough time with her parents? This usually sophomores and juniors, they're 1 foot out the door the second they get there anyway. They're like, oh. Or does she actually get along with you guys?
No, she'd rather stay home. She's not looking forward to going back. I mean, it's a lot of work. She's relaxing here, doing things. She was up till 4:00 in the morning Saturday night reading a book.
Yeah, you can't do that pleasure reading when you're in college, let alone with a tough course load. So, well, I have a book goal. This does anyone else have a reading goal this as a resolution?
I can't remember the last time I read a whole book.
Yeah, I read so many documents during the day that by nighttime I just can't read another page of word.
Yeah, I haven't read it. I don't have the patience to read a whole book. I mean, I watch some of these podcasts that last more than 30 minutes, and I have to turn them off. I just can't. I got to move on.
I would figure as a runner that you'd listen to you'd listen to books on tape or something like that.
When I'm running, no, I listen to music to keep me going.
All right. Well, we've covered all the important things. Reading goals 0, 0, and 16 for me. So have 16 books that's my over under, and I'm proud to say that I'm already 3 into it. So I'm well
Wow.
on my way to my goal.
That's
Well, because
impressive.
last year was embarrassing, and as an English major, if I'm not, I have to read. I'm going to make it a priority, and
So
I'm
are
not
these
going to. What's that?
fiction or finance or?
So I used to read a lot of nonfiction, like a lot. Like that was kind of what I would do. And now I'm just trying to read more fiction, more enjoyable reading. And one of my brothers texted me during this little break and said, I've never read War and Peace, and I think that we should try to do it together since it's 1,300 pages. It's good to have that go. And I was like, yeah, no, not gonna do it. Sorry. One of the greatest books ever written. Sorry, I'm not gonna be part of that. So now if any viewers want to tell me, like, if 20 people comment that I should read War and Peace, different people, not named Bob or Charlie, I'll actually read it. I'll actually undertake that long slog. By the way, even the best reviews say the first 300 to 400 pages are a slog, that if you can get through that, then it gets good. I'm like, 400 pages, that's a whole book itself. So all right, but for the non-English,
you should read The Panic of 1907.
All right, I'll have to add another one on my list now. All right, so let's get started. So today is January 12th, 2026. We could not have a better lineup than we have right now, because Bob Morris, oil and gas guru, Charlie Peabody, banks guru, big news on both over the last week, and healthcare. I think there's a conference going on this week, the JP Morgan conference, and in the last 24 hours, there have been more than 200 press releases from companies pre-announcing news that are attending the conference. So it's a big conference for everybody, and whatever. I'll get into some of that later, but I first want to talk about indictments, and the Fed and bank earnings are coming up. And so we have a lot of news. I think there are 2 or 3 major banks reporting this week, right, Charlie? And
they are starting tomorrow with JP Morgan.
And the big news, which do you want to cover first? The banks pre-announcing earnings, or do you want to talk about the unprecedented indictment of a sitting Fed chair?
Yeah, let's talk about the Fed, because if you go back to last night and watch the futures, they were open for about an hour before the Fed put out its Powell put out his statement, and they were trading sideways to slightly down, and then they really crashed once the Fed put out this statement. So they were trading around 7,000, and they cracked with the statement release. So the importance of the statement, it's the first time that Powell has decided to fight back. Up until now, he's tried to stay above the fray, ignore Trump's comments, etc. And so there are 3 statements he made last night that I think were significant and has caused concern in the marketplace. The first is he outright stated that the consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president, is what caused him to rebut or respond to Trump. So he obviously is saying our independence is at risk. And he goes on to say, this is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure and intimidation. And those are very brash statements, relative to what he's done in the past, where he's avoided any kind of commentary. So we now have a full-on fight between the Fed and Powell and the president. And I think it's very important to understand that, the independence of the Fed is critical to, stability in the markets. Now, obviously, there are a lot of hurdles that Trump faces in trying to replace Powell. In the Senate requires a 13-11 vote to confirm The Senate Banking Committee requires a 13-11 vote to confirm a new Fed chair. And the Republican from North Carolina, Senator Tom Tillis, said he would not vote on any new Fed nominee until this issue with Powell is resolved. So if you got 13 Republicans and 11 Democrats on the Senate Banking Committee, and Tillis, um, dissents, then you got a 12-12 deadlock. So it will be virtually impossible to change Powell. And then you need 60 votes in the full Senate, to confirm a Fed chair, which will be very difficult. So, in a practical sense, you're not going to get a change of the Fed chair until May, when Powell steps down. But this whole thing does raise a lot of concerns. One of them, the rating agencies have talked about, if the Fed independence is put in jeopardy, would it result in a downgrade of the U.S. debt? So those are things, that are very serious, that could have, impacts going forward. The other is, and I'll end it there, is does this raise the probability that Trump is going to go with Hassett over Warsh? The markets have spoken loud and clear that they don't like Hassett; they would prefer Warsh, and Warsh has gotten, an endorsement from Jamie Dimon at J.P. Morgan as being more credible. But if this, raises the probability of Hassett, you want to watch poly markets here, but if it raises the probability of Hassett being the next Fed chair, that's also going to, I think, hurt our confidence in that institution. Over the weekend, I wrote about this prior, actually, about 8 hours prior to the Fed, responding to Trump, and I said, Trump essentially is trying to change monetary policy regimes, and he's, essentially merging the Fed, the Treasury, and the GSEs to conduct monetary policy. And there are obviously repercussions associated with that. So yes, maybe he can do that and succeeds in running the economy hot, and that has a lot of implications as to how you want to play the market. I've been buying deep cyclicals, like chemicals, for example, but it overall, I don't think it does well for the general marketplace.
What's the chance that I mean, this is clearly I shouldn't say clearly. This comes across as an emotional decision, driven by, or the DOJ driven by an emotional retribution-seeking president. That's what it comes across as. Is it possible that the administration knows the weak employment data later this week, and this plays right into their hand, that we're going to see the CPI data come in pretty normal? We're going to see a weak jobs picture, and he can say, "Look, this is what he's been sitting on this. This is why he's really bad at it." I agree with your overall sentiment that he's done exactly what you want a Fed to do, which is make adjustments as they see. Some you might say were too little, too late, or whatever. You might have arguments about it, but no Fed has been perfect. So, and some have been really bad. But you wouldn't say he's, it's a hard case to make that he's been completely derelict in his duties. Now, he may have overspent on a renovation. Let's see about that. But do you think that there's any gamesmanship here on the data, and this is to protect the the narrative about, hey, we should have been lowering rates sooner?
The data right now is very suspect because of the government shutdown. And I would argue, listen, Powell has lowered interest rates 3 times in the, basically between end of third quarter and fourth quarter. And if you listen to his December 10th press conference, he was incredibly dovish. I was shocked at how dovish he was. So I thought in many respects he was playing into Trump's desires. I mean, he talked about how productivity was great. He talked about inflation being transitory. He talked about the need to support the employment picture. he put in place this overnight liquidity injection to calm down the repo markets. I mean, he did a lot in that December 10th FOMC meeting that played right into what Trump wanted. So I was a little bit shocked by what happened last night. But I think, listen, the data is very suspect. The economy, I mean, this is what you're going to hear this week. You asked about the banks. They're going to tell you the economy is very strong, that the fog around things like tariffs, trade, taxes is lifting. CEOs are becoming more confident, starting to make decisions. Loan growth is picking up. So I think you're going to hear very constructive commentary about the strength of the economy. And what is it? GDP now is running over 5%. So Dave, if you're right that we're going to get weak data from the employment front, I would discount it. The other thing that I'm looking at and really haven't pulled the trigger yet are these staffing companies like Robert Half or Manpower. These staffing companies, I think, are flat on their back. They're a good risk reward trade in my mind, because you got over 7 million, according to JOLTS, over 7 million job openings right now. You have, if you listen to the NFIB, the National Federation of Independent Businesses, they're telling you that they need to hire. And then you look at the ASA data. ASA stands for American Staffing Association. They've been showing increase in hiring since October, November. So I would argue that if anything, while the fourth quarter may have been weak, there's a pickup that's developing right now for sure.
So in the backdrop of all this Fed stuff, you have bank earnings coming out this week. Do banks, what do they look like going into this? Are we excited about them? Are we kind of more cautious? I know you've been cautious on JP Morgan, which is completely non-consensus. What should we be looking for here?
Yeah, I covered a lot of the bank earnings last week, so I'm not going to spend a lot of time on it. But let me cover what the credit card issues, because that obviously was the other issue that came out over the weekend. And then I can end up on any general questions on the bank earnings. But the bank earnings are going to be very, very positive. And the commentary going forward is going to be very constructive. So I'm not looking for any big negative surprises. If you have negative surprises, it's going to be around expenses. JP Morgan said that they're going to grow their expenses in 2026 at a 9% rate. And that was contrary to the idea that, AI was going to be a big beneficiary to bank, expense growth. And so that is the potential negative, is that other banks feel a necessity to play catch up with JP Morgan. And therefore your expense growth turns out to be a lot higher than we currently anticipate. And therefore you don't get as much positive operating leverage. And that's one of the big, factors that have been driving bank stocks higher, is the idea that we're going to get positive operating leverage. On the credit side, I'm not expecting any big negatives. And on the revenue side, it's possible that trading in capital markets and investment banking could be a positive surprise. So let me back off from that, and we can come back to that, David, if you want. But and talk a little bit about credit cards, because Friday night Trump tweeted that he wants credit card companies to cap interest rates at 10% for at least 1 year, effective January 20th. Now, it's a very conceptual statement. There's no details. There's no substance. So we don't know how he's going to implement that if it's real. And I always start off assuming his tweets are real and that there's going to be some follow through. But first of all, let me just say, if rates are capped at 10%, most of these credit companies are going to be unprofitable. Number one. Jen, if you can pull up the first slide, I have some. I give you some sense of what these. So the first column is the actual balances, so you can see who the biggest credit card lenders are, and I split it between the big banks and the monoline credit card companies. And then the second column is really what you want to pay attention to, and that's the yield, and it's the net yield. So it's the APR minus your cost of funding it. It's the net yield for these. And you can see that the monolines like Bread Financial, Capital One, Synchrony have the most to lose if rates are capped at 10%, and they would definitely be unprofitable. And that's the obviously the group that serves the lower end, the subprime.
And when he says the rates would be capped at 10%, does he mean that the yield would be capped at 10%, or does he mean that the combination of the yield of the
APR, the gross yield. So what I'm showing here is net yield, and he's saying the gross yield, which is the APR, would be capped at 10%. So that essentially makes everybody unprofitable. And so there are three potential trades out of this announcement that could develop. One is you buy the dip, and I think that's what's going on this morning, because most of the institutions I talk to say this is not going to happen. There's no way that Trump can impose this. The second is you get a rotation out of credit cards into the buy now, pay later companies, because so far they haven't been targeted by Trump. So if you're a subprime customer and you get cut off by your bank, you go to Klarna or Upstart or Affirm. And then the third is that you rotate into the regional banks, because they're not as big in credit cards as the big money center banks are. And so the regional banks are a potential. And the final potential is you just sell all of your financials, because you just don't know what this pay-to-play administration is going to ask of the banking system going forward. And that's something I've been writing a lot about, is that in a pay-to-play administration, if you're given capital relief and you're being deregulated, you're going to be asked for something in return. And the question is, what are you going to be asked for in return? And this is an example of the kind of thing that's going to be asked. So let me talk about why I don't like the monolines or the credit card business. And it comes down to, number one, we've seen a improvement in credit quality over the last 2 years because banks have tightened the credit box. But we've bottomed out in terms of credit quality, and now we're starting to see some rise in delinquency. So Jen, if you can go to the next slide. What I'm going to show you on this next slide is the top table is monthly delinquencies, with the left being the most recent data from November, and the bottom being net charge-offs. And if you look at those salmon colored lines, you can see that we bottomed in delinquency somewhere around July and have been rising, since then for this category of banks. And delinquencies are going to continue to rise into, probably February, March. What we don't know is this renewed deterioration in credit quality seasonal, because that's the typical pattern, that they peak in March, and then start to decline into June, July, and then rise into the winter again, or is it something secular? But we are going to see that the credit metrics start to show some deterioration.
When you look at previous periods, is it around these percentages, or is this running higher than usual?
No, I would actually say the year-over-year declines is greater than you would expect. So it does hopefully support the idea that the deterioration we're seeing now is just the normal seasonal pattern, not something secular. And then the good news, if you can go to the next slide, Jen, is the industry is very well reserved on the credit front. So the salmon colored column is the loan loss reserves that are set up for credit card exposures. And basically, loan losses or charge-offs for the credit card industry are running somewhere between 3 and 5%. And usually as a bank, you want to keep 1.5 to 2 years worth of reserves. So if you've got a 7 or 8% reserve ratio, you've got 2 years worth of coverage there. So banks are very well positioned to absorb any rise in delinquencies and charge-offs. So I'm not too worried about the credit side of the card industry. What I am worried about is,
if I can interrupt for 1 second. So when I'm looking at this, because this is super interesting, if I'm JP Morgan, I'm running a 6% reserve ratio, and I'm competing against a Wells Fargo that's running at 8%. Isn't that a tremendous difference in leverage? Like from, I
Well,
guess that's just, yeah, isn't it just an incredible difference? Because percentage point wise, it's not a lot, but on such a large balance, doesn't it show that JP Morgan's being more aggressive?
no, so it gets back to mix and maturity of your vintages of your maturity of your vintages. So J.P. Morgan deals really with the prime, super prime type of customer, and their charge-offs are running around 3.3%. In fact, tomorrow I bet you that J.P. Morgan will lower their forecast for credit card losses in 2026 from the previous range of 360 to 390. That's what they suggested it would be, probably down to the 330 to 360 range. So you'll hear them talk about how the trends on cards is still improving for them. Whereas Wells Fargo, they just started a credit card operation, ramping up a credit card operation about 2 or 3 years ago. And it takes a good 34 months for credit cards to mature and see peak losses. So that's why they're running with a higher loss rate. And if you look at
Someone
going
might
back
make
to the,
the joke that I just received 12 of them, but I wouldn't make that joke. Someone else might make a joke like that, given Wells Fargo's history.
you probably did receive 12 of them from Wells Fargo, because that's the mode they're in. They're trying to ramp up their revolving balances. And if you went back to the previous slide, you would have seen that their APR, their net, the yield, was running above that of the other money center banks. I think it was like 12% plus, whereas the other money centers were down 10 or 11%. And that's because Wells has got a higher mix of near prime and some subprime in their portfolio. So that's why they're carrying a higher reserve ratio than J.P. Morgan. Sorry, I hope that answered your question.
Yeah, no, it does. Thank you.
All right, but the real concern, so I think they're solid on the credit front. The real concern is on the revenue front. And expenses, they're not going to change a lot in the short run. And maybe AI helps in the long run with some of their call centers and reducing expenses in the back office. But so the real issue, for cards is going to be what happens on the revenue front. And you got two sources of revenues. You got fees, things like interchange fees, late fees, annual card fees, et cetera. And you have spread income, net revenues, which is what the APR will determine. So let's go to the next slide. On what we're seeing on the fee side is fees are no longer growing. If you can go to the next slide, Jen. Okay, fees are no longer growing, and what's happening there is reward costs. The 3% cash back that you're getting, or the $100 rebate from buying from some retail outlet, are increasingly eating up all of your other fees, like interchange fees. And here you can see, this is JP Morgan's liabilities for rewards. So when you give somebody rewards, those rewards aren't redeemed day one. They're redeemed at some point in the future. And you have to set up a contra account against your fee income for that fee that you're eventually going to give back in the way of rewards. And those liabilities are growing at double-digit rates, which is much more rapid than what the fees are growing at. Like interchange income is growing at mid-single-digit rates. Late card fees and credit card fees are rising. Annual fees are rising at a low single-digit rate. So your reward costs are growing at double-digit rates, which is a contra account to your other fees, which are growing at mid-single-digit rates. So basically, fees are not a source of revenues going forward. And you can see this in the next slide. If you can put that one up, Jen. The next slide is going to show you how much of your reward costs are being eaten. How much of your fee income, such as interchange fees, are being eaten up by reward costs. And it's about 3/4 of your interchange fees are being eaten up by reward costs. So the fee picture right now is deteriorating. And if we were to get some forced change on the APR, that's going to have to change. But there's going to be an adjustment period there where the industry is unprofitable. So let's go to the next slide, and I'm hoping this is the final one. I don't know if you can read this, but this is my P&L for JP Morgan's credit card operation. Banks don't break out their credit card operations specifically in terms of a P&L, but given some of the guidance they give, you can develop your own P&L. And what I have there in yellow is fee income as a percentage of revenues. And you can see in the third quarter for JP Morgan, I don't know if you can see it, but trust me, in the third quarter, JP Morgan's fee revenue was negative as a percentage of total revenues. So all of their revenues are coming from spread income. And so now we come to the point of what's going to happen to spread income if the APR is capped at 10%. And the bottom line of all of this is these operations would be unprofitable. And that's probably not going to happen. The industry will fight this tooth and nail. Usury laws are set at the state level, not the federal level. So there's a legal challenge there. The feedback or the response I got this morning is, from institutional investors, is buy the dip. This isn't going to happen. So that's where things stand.
All right. Would you do the same for the monolines?
I don't like where this, we're going to have pressure on APRs, whether it's 10% or 15%, I don't know. There's going to be legislation. I mean, Bernie Sanders and Alexandra Ocasio-Cortez, I think that's her name, Ocasio-Cortez from New York, have submitted a bill. I think it's S181 or 131. I can't remember. Anyway, to cap rates at 15% for the next 5 years. That bill is now going to get renewed momentum. So I don't like where this industry is headed in terms of their profit dynamics. So I'm not a buy into the dip. I would rather rotate into the regional banks, and that's been my trade, is to buy the regionals. Things like U.S. Bancorp, USB, or M&T, MTB are my two regional bank picks.
All right, perfect. Well, that's comprehensive and educational for me, at least, because I didn't really understand it before now. So, Bob,
let me just finish with one statement, because it's a lead into Bob, but I'll hand it back over to you, Dave.
Absolutely.
I mean, this administration is now picking winners and losers, and that is for me, a difficult thing as a fundamental analyst, because you add a political angle to fundamentals, and that political angle is always difficult to anticipate. But over the weekend, Trump did say that Exxon would not be part of their Venezuelan plan, because the Exxon chairman came out and said that Venezuela was uninvestable. And so that type of precedent, saying, okay, these credit card companies aren't going to work, but these BNPL companies are going to work, or banks, can't return. As you said, with the defense companies, banks can't return capital to shareholders through buybacks and dividends. They have to grow their portfolio to support my run-hot economy. These kind of decisions at the administrative level, I think, are very negative for the markets in general. So I'll leave it there.
Bob, do you agree, disagree, or are you fine with someone says something wrong? If you're my enemy, you don't get to come to the party approach to oil and gas?
I mean, I think the Trump administration's been very black and white. You're either with them or you're against them. And I think, to Charlie's point on ExxonMobil, the chairman of ExxonMobil came out and said Venezuela's uninvestable. And Trump said, well, you're not going to be part of the program to revive the industry there, which is not surprising at all. And the big news was that in looking at oil and gas and what's going on this morning, the meeting on Friday between the Trump administration and a lot of these oil and gas executives, really nothing definitive came out of that, which is not surprising. We didn't expect any definitive action or statements or policies coming out of it. And obviously, one of the big things at the top of Trump's wish list is lower prices at the pump. And he's been doing everything to push that. And the biggest thing he can do now is revive the industry in Venezuela. And two things. One, near term, oil prices are under a little bit of pressure here this morning, because there's about 50 million barrels of oil in inventory in Venezuela that the Trump administration expects to begin selling within the next week or two. And those barrels will come into the market, which on the margin is more oil in what is already an oversupplied market here in 2026. Longer term, though, our view that we laid out initially is that it's not going to be in the next 2 years you're going to see any significant uptick in production of oil from Venezuela. No matter what happens, it's going to take more than 2 years to see anything significant occur here because there is a lot of investment that has to take place to fix what is a broken infrastructure in Venezuela. And that's going to take some time. And even if they started tomorrow, but they're not going to start tomorrow because oil and gas companies, they want one security in Venezuela and they want a very clear and firm hydrocarbon law that they know their assets aren't going to be repatriated for a third time, which is, the big fear of the Exxons and the Conocos and those that have had their assets repatriated twice already. And so there are a lot of hurdles that have to be crossed before any oil and gas company of size feels comfortable investing in Venezuela. Now, there may be some smaller companies that raise money and, go, oh, we raised $1 billion or $2 billion, but that's not going to change things on the margin. You need the majors, the Chevrons, the Exxons, the Shells of the world coming in and investing big dollars. And so while that's sort of weighing on the oil markets today, particularly that 50 million barrels a day, to Charlie's point, yeah, Trump's going to push. He's going to continue to push hard, and you don't know what other sticks he's got to try and hit people over the head to get that investment to occur. But that's something he wants to have happen, is to unleash that oil potential in Venezuela. So we'll see what happens there. But in the meantime, there's a lot going on around the world. On the other hand, we see what's going on in Iran, and a lot there, uprisings, and whether or not that regime's going to be toppled. You look at Poly Market this morning, it's probably 50-50 chance they think that their regime in Iran is toppled and there's regime change. And Iran exports about 2 million barrels a day of oil, and sort of countering the increase in production from Venezuela, whether near term or long term, is the fear that any regime change or escalation in what's occurring in Iran constrains their 2 million barrels per day of exports. And so that's the concern on the other side. That's the geopolitical risk on the other side. And who knows what's going to happen there, but it doesn't look good at the moment. As you probably saw a couple of days ago, Iran did a complete blackout of the internet, and they're bringing in forces from outside of Iran to try and quell the uprisings, and who knows what's happening that we're not aware of. But they're at a critical point where they need to shut down this uprising or risk the regime being overturned. And that has a lot of implications either way for oil production exports from Iran and the oil prices. So we'll wait and see.
For 1 second. So stop for 1 second. So if you have a kind of dictatorship, mullah run regime, how is a change to, if it is toppled, and how is that disruptive to volumes? So walk us through. I understand the risk off part of it, of like, hey, listen, there's chaos and who knows how this plays out. There could be lots of people drawn into this. Do we start bombing targets and so that creates a whole bunch of uncertainty. But that aside, in not in the long term, but in the short term, how does a regime change affect supply?
Well, one, who's running the wells? If you've got regime change and disruption, the people that are in charge of the oil and gas industry, are those part of the current regime that try to flee the country and leave, and who takes over and who's running the oil and gas infrastructure there? And is this something that other proxies in the region jump into and somehow disrupt any flow of oil out of the Strait of Hormuz? Or there are a lot of things that could happen that you just don't know who's going to try and block or who's going to be running things in the meantime. And also, like with Venezuela, if it's a similar situation where then the powers that be are trying to implement a new regime that's more democratic or whatever, then there's revenue from oil that, yeah, if they're friendly to the powers that be, then they'll let them have the oil revenue and let that flow or be exported. But on the other hand, if it's chaos and it looks like there's a still not friendly regime that's going to take over, run things, or control things, you still want to control the oil flow and the revenues that they might have access to. And so it's a lot of uncertainty. There are a lot of things that could interrupt the flow of oil. And you know, it's unlikely to be a situation like Iraq where the outgoing regime sets everything on fire on the way out or anything like that. But there's a lot of uncertainty as to what is allowed to happen and who's running the shop or who's in charge of the factories in the meantime.
Okay, thanks. I didn't
I mean,
understand
it's
that.
a lot of uncertainty, and you've a lot occurring here between what the Trump administration is doing in Venezuela, what they're threatening Colombia and Cuba with, what they're threatening Iran with, and you've got on the sidelines China and Russia watching all this, saying, "Wait a minute, are we going to let this happen? Is this setting a bad precedent? And are we going to let the U.S. sort of control all these countries, some of which have been sort of our allies or we do business with, and how does this all unfold in the long run and with all these different actions being taking place around the world, Greenland in there too? I mean, it's a lot going on.
Yeah. So actually, so there's a theory, there's an approach, which is actually a Chinese approach called the falling leaf strategy, which you overwhelm your adversaries by doing so many things at once that it's very hard for them to figure. It's like falling leaves in the autumn.
Mhm.
They don't know where to focus. Do you focus on Cuba and being toppled? Do you focus on Venezuela? Where do you bring your ships? You're in the you're off the coast of Taiwan. You're here. You're there. It's a very interesting, you're right, chaotic time of foreign policy and events that are happening. But I don't think it's as uncoordinated as some might think it is. I think it's actually a foreign policy strategy. We'll
Well, I
see if it
agree.
works.
It's a strategy, and I think Trump likes that. Trump likes
Yeah.
chaos, and
Well,
he likes to operate in that environment to see then what he can push through.
you
And
know,
go
you
ahead,
know who's
Charlie.
not like that. That is the markets. So if you
Yeah,
apply falling leaf strategy to the markets, you bring up David Tepper's rule, and that is markets can handle two or three, unknowns or uncertainties, but when it gets to be four, five, or six, the markets can't handle that. And that's the direction we're headed into now. The uncertainties around so many different issues are going to overwhelm the markets. And I've been of the belief that we are creating some kind of top here in the banks here in the first quarter. And in the meantime, the Mag 7 are trading very poorly. So if you lose the leadership of the Mag 7 and the banks, this market can't remain elevated. It's going to correct into the spring. And that's kind of my feeling.
Yeah, it is interesting because you look at this and you see Chevron is doing well today. Exxon's CEO probably regrets having opened his mouth at the meeting at all. His statement really wasn't wrong, right, Bob? That it
no, it
seems
wasn't
uninvestable.
wrong. And look, these big companies are going to be very cautious in going back into Venezuela. They don't want to face a lot of risk, and one of the risks is, well, we're going to go in and invest billions of dollars to get production out of Venezuela that may increase our total company-wide production by 2, 3, 4%, to lower the price on the other 95% of our production by $10 a barrel. I mean, they've got to weigh, the pluses and minuses. And if you're given in the Trump strategy of driving oil to $50 a barrel, all of a sudden, all this shale production in the U.S. looks a lot less profitable, and that becomes an issue too. So, they're going to play it from the cautious side. They're going to play it from the view that, look, we really, really got to know that we're going to be safe and secure and make money, and this is all going to work in Venezuela, and we're nowhere close to that today.
So David, let me raise another high level question. So tomorrow, Jamie Dimon kicks off earnings at JP Morgan. And everyone today is asking, how is he going to respond to Trump's tweet on credit cards? So he's literally in the same position. Is it the chairman at Exxon is Woods? Is that right?
Yes, Darren
Yeah.
Woods. Yeah.
He's literally in the same position as Woods right now going into tomorrow morning. And so everyone wants to know what's he going to say so that he doesn't be excommunicado. But that's the bigger question now is in an election year, we're going into the midterms, and I've been saying affordability is going to be the term of the day, the week, the month, the quarter, all the way through to the midterms. Um, how how do you avoid crossing Trump And is at a very high level, is there going to be a redistribution of wealth out of corporate America into the consumer, or out of Wall Street into Main Street? And if there is, that's very dangerous for this market, because right now at 23 times earnings or 22 times earnings, depending on what your earnings estimates are, this market's elevated on a PE basis. So all of the growth in the market, or the appreciation of the market this year, is supposed to come from the double digit growth in earnings. Well, with corporate margins near all-time highs, greater than 13%, if you have a redistribution of wealth away from corporate America into, some other body, whether it's the government because of defense, or the consumer because of credit card caps, that's not going to bode well for earnings growth this year, which, expectations are pretty optimistic. So I I'm worrying about this market right now, if we get this redistribution from Wall Street to Main Street.
But one of the problems, right, is, and I was actually talking to someone earlier today about how people rarely make valuation calls on the street because they like the narrative. And right now, the narrative is, and you mentioned it earlier about our GDP growth versus the rest of the world. Hard to find that type of growth. Ignore the value for a second, and so you have this sloshing bucket of money that's trying to find cheap areas, but also looking to find growth. And right now, the growth is what's winning. So it's
Yeah, but that growth is dependent upon the status quo. So if you're looking at home builders, and Trump is going to push the home builders to support the housing industry by, promoting the use of land lots at a time when you already have record spec inventory, that's not going to help margins. If you cap interest rates on credit cards at 10%, that's not going to help margins. So I think there's a real risk to the optimism around earnings, not the multiple.
Yep.
Hmm.
What says you, Bob?
On the other hand, if we're going to look at GDP growth of 5% or more, that's positive for energy demand in the long run, and positive for the energy companies, because again, the downside risk to oil is really near term, 50 million barrels of oil in inventory in Venezuela that gets unleashed. We're not going to see any big uptick in Venezuela production anytime soon. The other side of the risk is there's some disruption in Iran if that regime gets toppled. And so you look at oil here still floating close to $60 a barrel. That's a price that I think makes these energy companies still attractive valuations. So I'm not selling it. I'm definitely not selling anything here. I'm watching things carefully. The other side of it is natural gas, and winter to date, we've had a warmer than normal winter. We had a cold spell there, but winter to date, we're warmer than normal. Natural gas storage inventories are close to the 5-year average, and we're looking at maybe some cold weather here near term, but that's weighed a little bit on energy stocks. Natural gas prices, which were way above $4, have come back down to, what are they now? They're closer to 3.25. So you've seen some of these names like Expand and EQT and Taro Range pull back a little bit here. And, I still like those names, keeping an eye on them, but we're unfortunately sort of at the behest of weather right now, and how that plays out for the rest of the winter, where storage inventories are coming out of the winter. But I'm not selling those names either. I'm sticking with my Expand and EQT. And, as far as doing anything right now, I'm just keeping an eye on Valero to, like I said last week, I was building a position there. I never got the full position. Then it popped on this whole Venezuela issue. So if I'm doing anything near term, it's maybe continuing to build my position in Valero if we see a further pullback in Valero. That's a refiner that benefits from lower crude oil prices. So a bit of a hedge on some of these producers. But otherwise, it's a lot of crosswinds, a lot of headlines, both on natural gas and crude oil that's hard to predict. And I'm sticking with my core names. I'm not selling anything here.
All right. Well, I'm going to just touch on healthcare. Even though I'm a moderator today, I'm not a participant. I'm going to be very fast because, again, I'm not supposed to have any content today. JP Morgan, I mentioned the conference just is starting, and something like 250 press releases went out over the last 24 hours, some pre-announcing, some just giving updates to where guidance is. The companies that come out with, hey, I'm going to pre-announce the year, but not give guidance, that's not such a great look. So people don't like that uncertainty. They want both. And some have put out press releases for news that they want to talk about, like EBS, a stock that I actually like, is down 5% today. They came out and said, oh, we have a new contract. They didn't come out and say, oh, by the way, we're blowing through numbers. And again, I like that stock. I think actually it's going to be $20, but we'll see. It has to get to 15 before 20. So Syndax, another company that I like, had some positive news out. They pre-announced SNDX, and some others. Teva came out with a lot of good news over the weekend. One is actually really interesting that people will have to dig into, which is they did a deal with Royalty Pharma, and Royalty Pharma is going to fund the development of one of their drugs. And that's great news because it takes some spending off the P&L and gives them a little more flexibility for making earnings this year. The issue with that, though, is that's kind of, they're going to be paying for that later when the drug does get approved. But the stock's reacting really well today, up 4%, now $33 on that news. They also said that, hey, the numbers came in great. So overall, very good news. I'm still sticking with it. And we haven't yet had any really big pre-announcements from the large cap companies, which when Charlie mentioned that we have an administration that might be picking winners and losers, they kind of picked that the drug industry would be winners, right? They said, oh, you're going to have to pay up, put your things into Trump RX or whatever he named the website, and give people a break on drug prices, which I don't know if anyone's picked up a prescription lately, but I haven't seen anything for my copay or any big savings yet. I don't think people are really going to see that anytime in our lifetime. So they've kind of let them go because they fell in line very quickly. For companies and industries that aren't falling in line very quickly, I'll just tell you that that's not going to work well for you. So I still like the XLV and the XBI as kind of baskets for if you're interested in healthcare. But the easy money last year is not going to be repeated this year. We do need to see what happens with some of the ones that are over-owned, like Lilly. What happens now that your prices have gone from $1,300 to $300? Like, can you still do all this M&A and still put up great numbers? But so I'm a little bit more cautious than I was at the end of last year, because this year is going to be tougher, but they're still in a really, really good spot. So with that, it is the 12th of January. Go to wallstreetbeats.com to sign up for behind the scenes discussions where we debate each other, where we talk about our individual stocks. Go to passes.com/wallstreetbeats for the same. And we look forward to seeing you for the rest of the week. Lots of news going to happen. Certainly not, we certainly do live in interesting times. For Bob Morris, Charlie Peabody, I'm David Maris. Have a great week.
Thanks, David.
Thanks,
Bob.
David.
Thanks, Jen.
Thanks.
Thanks, Bob. Thanks, Charlie. Thanks, Jen.